You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have NatWest, Coca-Cola HBC, BAE Systems, InterContinental Hotels, Entain, and our US company of the week is Disney. Sam, shall I kick us off with NatWest?
Absolutely.
Okay, so NatWest, the FTSE 100 listed bank, had their half-year results out last month, with total income up 21% to £6.2 billion, with a 16% rise in net interest income to £4.3 billion. Meanwhile, other income came in at £1.9 billion, up from £1.4 billion compared with the first half of 2021. Along with the boost from rising interest rates, the group's operating expenses only rose by around £150 million, resulting in operating profit growing 53.5% to £2.7 billion. If we break those results down a little further, then the retail banking division saw total income grow to £2.6 billion from £2.2 billion, with higher deposit income from rising interest rates. Net loans to customers also grew and came in at £6.5 billion, with continued mortgage growth. Meanwhile, net interest margins increased from 2.26% to 2.53%. In the private banking arm, income grew from £368 million to £461 million, with increased deposit and lending growth with new money despite the volatile investing conditions. Net interest margins increased from 2.62% to 3.34%. And in the commercial and institutional division, net interest rose by around £300 million, totaling £1.8 billion, and total income was up by 18.7% at £2.9 billion, with higher interest rates, higher fees, and a growing balance sheet underlying. NatWest's CET1 ratio, an industry measure for capitalisation, was 14.3%, compared with 14.7% at Lloyds, 13.8% at Barclays, and 14.1% at HSBC. And the group's cost-income ratio fell from 67.6% to 58.3%. Alongside these results, NatWest announced an interim dividend of 3.5p and a special dividend of 6.8 pence per share. The group said, "We continue to monitor the evolving economic outlook and are mindful of the impact that high levels of inflation, higher interest rates, and supply chain shortages are having on our customers." On the news, shares were up over 7%. And in terms of valuation, NatWest has a market cap of just under £27 billion and trades at around 10 times earnings, with a forward price to book ratio of 0.65, which is broadly in line with its 10-year average. And it has a prospective dividend yield of nearly 5.5%. I thought these results were excellent from NatWest, and seeing it benefit from the rising interest rates. It's also got a very healthy balance sheet, which will be even healthier with the proceeds from the sale of the Republic of Ireland business. It looks like it's going in the right direction, and the UK government stake is now less than 50% in NatWest. But I suppose the main thing that would be sort of holding me back from buying more NatWest shares is the fear of an ongoing deep recession and collapse of the housing market. It's certainly not expensive at the moment, and it's one that I own and will continue to hold. Probably won't be adding to at the moment. Sam, what are your thoughts on these results in NatWest?
I thought they were pretty decent. So when I had a look, NatWest actually, most of the income it gets is from the money it makes on interest payments. So if interest rates keep going up, that should be quite good for them. I think interest rates are going to keep going up. I don't know how much growth you're going to get out of it, but in the longer term, it's just going to, I guess it's very cyclical, isn't it? It's going to rise and fall with interest rates. But I think at a P of 10 with 5.5% dividend yield, it's not the most exciting business, but no, I think it looks quite good.
One that you'd add to your watch list, or is it just not the type of stock for you?
Just not the type of stock for me. But again, like if I was coming at it from more of an income perspective, I'd certainly consider it.
Yeah. Rather than having it on deposit, the money on deposit in NatWest.
Yeah.
Okay, fine. Coca-Cola HBC.
Yes.
Former favourite.
Wow, who said former?
Oh, okay. Tell us.
So Coca-Cola HBC. So for anyone who doesn't know, we have covered them on the show a few times before, but it's a Coca-Cola Hellenic bottling company. And what that is it's a Greek Coca-Cola. So it actually used to be listed in Athens. It was the biggest company on the Athens Stock Exchange. And then it came over here because we've just got a better stock market than the Greeks. So it's Coca-Cola, but it's got I'll just get it, but the countries it operates in are Armenia, Austria, Belarus, Bosnia and Herzegovina, Bulgaria, Croatia, Cyprus, Czech Republic, Egypt, Estonia, Greece, Hungary, Ireland, Italy, Latvia, Lithuania, Moldova, Montenegro, Nigeria, North Macedonia, Northern Ireland, Poland, Romania, Russia, Serbia, Slovakia, Slovenia, Switzerland, and Ukraine. So it's got a heavy Central and Eastern European focus, as well as a few other emerging markets, which is what I think last time we covered it on the show. One of the things we quite liked about it, because it's an emerging markets play, but with the Coca-Cola brand. They have come out with their first half results, and well, I should caveat this by saying that as 2 of the 24 markets they operate in are Russia and the Ukraine. So there's going to be some impact from that. So they've come out with their half-year results, and organic revenue is up 19.4%, and reported revenues are up 29.6%. So there's a big difference this year between reported and organic, because they only acquired the Egypt business during the year, so that's given them a big boost. Excluding Russia and Ukraine, organic revenue was up 25.2%, with volume up 12.1%. So Russia and Ukraine's dragged the revenue growth from 25.2% down to 19.4%. Organic revenue per case grew 14%, and that benefited from pricing and targeted action to improve the mix, further supported by out-of-home channel recovery. They said the integration of Egypt is progressing well, which added 7 percentage points to revenue growth. Organic EBIT was up 23%, with margins up 30 basis points on an organic basis to 11%, benefiting from pricing mix and cost discipline. Marketing expenses, excluding Russia and Ukraine, increased by 9%. Coffee volumes were up 56%, with accelerating contribution from out of home. Comparable EPS was up 33.9%, and free cash flow increased by 55.4 million euros to 332.9 million euros. If we break it down by segment, so they split the countries into 3 segments: established, developing, and emerging. So established organic revenue increased by 19.1%, with well-balanced volume and revenue per case expansion. Organic EBIT expanded 26.5%, with margins up 60 basis points. Developing organic revenue was up 33.6%, led by strong share gains. Organic EBIT was up 63.8%, with margins up 120 basis points. Emerging organic revenue was up 14.2%, driven by momentum in markets excluding Russia and Ukraine. Organic EBIT was up 15.5%, with organic margins up 20 basis points. If we drill into the numbers a bit more in terms of the number of cases, volume increased by 18.1%, of which 4.7% was organic. Operating profit was down 21.3%. So despite these very impressive numbers, operating profit's down 21.3% to 275 million. The reason is the Russian business. They've basically just had to write all that off, and that's gone through as a loss in the P&L, but it's a one-off loss, and it's not actually a cash loss. It's just all the plant and stuff that they don't really have anymore. So it's kind of a paper loss, really. It's not actually lost that much money, although it has lost all the assets. But yeah, so that's the operating profit. But then if you do comparable operating profit, it's actually up 32%, with 23% of that being organic. Net profit is down 34% to 152 million, and comparable net profit is up 34.5%. Basic earnings per share are down 34.6%. However, comparable earnings per share are up 33.9%. And free cash flow, which is probably the best way to measure the business this quarter, because that impairment, there's no cash going out the business. In terms of the free cash flow, it was actually up 20% to 332.9 million euros. And all the figures are in euros, by the way. They said in 2022, they expect to generate positive organic revenue growth at group level. Going forward, our presence in Russia will be significantly smaller than in prior years and focus on existing local brands. Our expectation is for this local business to be immediately financially self-sufficient. And they've gone into this in a bit more detail. We continue to prioritise the safety of our people and their families who have been affected by the unspeakable tragedy in Ukraine. On 24 February 2022, we temporarily closed our plants and stopped production for safety reasons. Since May, we've progressively restarted manufacturing in Ukraine and are currently distributing and selling beverages where it is safe to do so. In Q2, volumes in Ukraine declined by 45%. On 8 March, we stopped placing orders for concentrate of the Coca-Cola company's branded products in Russia, and we've worked in close alignment with the Coca-Cola company on the implementation of its decision to suspend its business there. We've ceased investment in Russia and will not deploy new capital into the market. In Russia, volumes declined by 46% in Q2, and we expect some further declines in the second half. Going forward, we expect to have significantly smaller presence in Russia, focus on local brands, which will be immediately operationally and financially self-sufficient. We've incurred non-cash charges of 188 million and cash charges of 2 million. So in terms of the valuation, the business is a PE ratio of 19, and that includes that big drop in earnings. Although there's likely going to be enough. Actually, no, there might not be that. I don't think there'll be a big drop again in the next half because you've already had that impairment go through, and that was the bulk of it. So I think the bulk of the drop has actually happened. So it's trading at 19 times earnings, is pretty similar to when we last covered it. The only difference is those earnings are lower. It's now trading at a share price of £20 per share, and last time we covered it, it was about £25 per share. My view is, I think, given the circumstances, I think these are excellent results. I think the impact from Russia and Ukraine has been as minimal as it can be, and I'm not concerned about that impairment charge because it's a one-off and it's not a cash expense. I actually still quite like this business. I think at £20 a share, and that's on the reduced earnings, which include the impairment. I don't think it's, in 2 or 3 years' time, I don't think, even if there's hardly any presence in Russia apart from those local brands, I don't think it's really going to affect the business. I think it was well diversified enough that although it did actually have a sharp drop, it dropped 40% after the invasion of Ukraine, but Russia did not make up anywhere near 40% of the business. So I actually think it's quite fairly priced at the minute. John, what are your thoughts on the results, and has the current situation changed your view, or is it still a favourite of the show?
I actually think the results, it still remains a favourite of the show. I would be disappointed if I'd been a shareholder and I'd be lamenting the loss of, I suppose, the Russian and Ukraine side of the business. But there's nothing you can do about that. And yeah, it's now reflected in the price. So certainly, if you're coming in to take a position, I don't think it would probably affect me in terms of my decision to buy shares. So I still like it. Would I buy shares now? Personally, it's definitely on the watch list. There are other stocks around, but it's on my watch list for sure.
Well, there's Russia and Ukraine. There are only 2 markets out of 24 that it operates in.
Yeah.
So it has shown how well diversified it is.
Well, yeah, that is something. And I suppose it also does reflect that in what you might consider emerging markets, they can be more volatile. And things like this, I mean, not that anybody was predicting that this would happen, but can happen. And political instability generally in emerging markets can, influence companies and obviously the shares accordingly.
Okay. So should we move on to a bit more of a stable business?
Yes. Well, I suppose it links quite well with that. So BAE Systems, the UK's largest defence company listed on the FTSE 100, had their half-year results out last month, with first half revenue up £546 million to £10.6 billion, and underlying profits growing 8.2% to £1.1 billion. In the electronic systems division of the business, sales were up 6.3% to £2.3 billion, despite ongoing supply chain issues, and operating profit grew by £24 million with stable margins. There's a particularly strong demand for the laser-guided rockets, the Precision Strike, and the C4 ISR offerings, which include technologies and services that optimize situational awareness and actionable intelligence for military and intelligence decision makers. The order book rose from £6.6 billion to £7.7 billion. In their services and platforms division, sales grew 2.7% to £1.6 billion, although when factoring in exchange rates, this was actually down 3% with fewer US ship repair volumes. Operating profits, however, did grow by an impressive 33.9% to £146 million, with efficiencies and more profitable combat vehicle and ship repairs. In the air division, the F-35 fighter plane production was at full capacity, and the maturation of the Tempest combat air systems technology helped sales improve by 3% to £3.5 billion. The division is working hard towards delivering the first Typhoon aircraft to Qatar in the second half. Profits were broadly flat, with a small increase of £2 million to £362 million. In maritime, sales were up 6.3% to £2.2 billion, with volumes growing on the Dreadnought submarines and the Type 26 ships. Profitability, however, fell, and operating profit was fairly static at £182 million on the back of a strong performance last year. In cyber and intelligence, sales rose 11.2% to £1.1 billion, with a strong performance in digital intelligence and the US intelligence and security businesses. Operating profits rose 26.8% to £123 million. Free cash flow came in at £123 million, and net debt grew by £975 million in the half to total £3.1 billion. Alongside the results, BAE Systems announced an interim dividend of 10.4 pence, which is up 5%, and also a share buyback programme worth £1.5 billion to be delivered over the next 3 years. Full-year guidance remains unchanged, with sales growth of between 2% and 4%, and underlying operating profit growth expected to be between 4% and 6%. In terms of valuation, BAE has a market cap of £25 billion and trades at just under 15 times earnings, compared with a 10-year average of around 12, and the shares yield in the region of 3.5%. I thought these results were pretty good, but perhaps not quite as good as the share price performance has been over the last year, which is up over 40%. What is positive for the company, though, is the Ukraine situation, global instability, and the reaction of the West to the situation to commit to increased defence spending, and the continued growth in the cyber and intelligence division. And that, I suppose, is the more exciting thing about the company, is that cyber and intelligence. And as particularly Western countries face more cyber threats, as warfare evolves, that is a growth driver for the business. Probably not one for me overall, but I think it's probably a company that's been more interesting now than it would have been a few years ago. I guess that's reflected in the price. It's trading higher or at a greater valuation than it has done for some time, and certainly significantly above its 10-year average. It's also got a pretty decent dividend, so it could be literally a defensive stock in one's portfolio. But yeah, probably not one for me. Sam, what are your thoughts on BAE Systems?
Yeah, it's definitely not for me. It just goes in the too hard pile. I'd sort of view it similar to like a pharmaceutical company. Like, I don't really know how I'd value the pipeline, and I just find it too difficult. I don't really understand it, and I'm not overly interested in it either. I do remember we've covered this once before on the show, I think, and I remember it being quite cheap then, whereas now I've looked at it and it seems quite expensive, but I guess the business is doing better, isn't it? But yeah, it's just not for me. But these results look pretty decent.
Okay, on to our next company then, InterContinental Hotels.
Yes, another company we have covered before. So this is it was a Terry Smith company. He did have it in Fundsmith for a while, but I think he gave up on it like a year or two ago. But it fit into that asset-light business model that he tends to look for. But just to give an overview of the business, InterContinental Hotels Group operates a portfolio of hotel brands, including Six Senses, Regent, InterContinental, Vignette, I don't know how you pronounce that, Kimpton, Hotel Indigo, Even Hotels, Hualuxe, Crown Plaza, Voco, Holiday Inn Express, Holiday Inn Club Vacations, Avid, Staybridge Suites, Atwell Suites, and Candlewood Suites. The company operates approximately 6,028 open hotels, which is 884,000 rooms in over 100 countries. The Americas segment has over 4,268 hotels. The Europe, Middle East, and Africa segment has more than 1,137 hotels, and the Greater China segment has more than 586 hotels. They have come out with their half-year results, and revenue is up 49% to 840 million, and all these figures are in dollars, by the way. Operating profits up 101% to 377 million. Revenue from fee business is up 31% to 664 million. Operating profit from fee business is up 66% to 372 million. Fee margin is up 11.8 percentage points to 55.9%, and the earnings per share is up 201% to 121.7 cents. So these look pretty fantastic. So the initial reaction is, were there easy COVID comparisons? And there were. So if we go through those same figures and compare them to the 2019 results instead of 2021, revenue was still 17% lower, operating profit 8% lower, fee business revenue 9% lower, operating profit from fee business 6% lower, fee margin was 1.8 percentage points higher, and earnings per share was 18% lower. In the Americas, the revenue per room was up 45% compared to a year ago, but down 2% compared to 2019. And for the US on its own, that was up 40% and flat versus 2019. The owned, leased, and managed lease profit of 9 million compared to a loss of 12 million in 2021. And that was down 12 million from 2019. Pipeline, they've got 100,000 rooms with 12,000 signed in the half. For Europe, Middle East, Asia, and Africa, revenue per room was up 138%, but down 21% compared to 2019. They exited 6,500 rooms following the cessation of operations in Russia. Owned, leased, and managed lease revenue increased by 87 million to 118 million, and that was down 62 million versus 2019. Pipeline's 80,000 rooms with 8,000 signed. Greater China, revenue per room was down 27% and down 46% compared to 2019. Net rooms is up 5.9% compared to a year ago. Pipeline's 98,000 rooms with 11,000 signed. And they've signed 30 franchise contracts in the first half. In terms of the fee margin, and fee margin excludes the owned, leased, and managed lease hotels. So this is basically the margin on the franchising. So rather than operate the hotel, they'll just give you the franchise, and you can go and have the risks of running a hotel, and they just collect a nice fee every year or whatever it is. So in America, the fee margin is now 82.8%, and that's actually up from 2019, which was at 77.3%. Europe, Middle East, Asia, and Africa, fee margin is 49.1%, and that's down from 2019, which was 57.8%. In Greater China, fee margin is 13.9%, and that's down from 54.5% in 2019. This isn't really that relevant to the results. I just found it interesting. But for Holiday Inn, they've got 220,900 rooms in 1,206 hotels, and they've got pipeline for another 47,200, which is 245 hotels. So the pipeline's 21% of the current size, which I was quite impressed by. In terms of the total rooms that they've got, the 883,000, franchised 71%, and then 28% are managed. And of the total rooms, 57% are in the Americas, 18% Greater China, and 25% Europe, Middle East, Asia, and Africa. And the pipeline rooms, 36% are America, 35% Greater China, and 29% Europe, Middle East, Asia, and Africa. In terms of the valuation, the business trades at a PE ratio of 38. And although it is initially quite an attractive business model, in fact, let's have a look at the financials over the last 5 years. 17 to 18 revenue increase from 2.9 billion to 4.3 billion, and then up to 4.6 billion. In terms of the share price, it is basically it's priced as if COVID didn't happen. And as we see from those results, there's still a little way to go. These results, I think, are quite lackluster compared to 2019 levels. I know they are at the mercy of the market, and things aren't quite back to normal, especially in Greater China, which does make up 18% of the rooms. I don't know. I just think if I'm paying 38 times earnings, they're depressed, but they're not. In fact, what were the earnings compared to these earnings compared to 2019? They were only down 18% compared to 2019. That's still, even if it goes back to normal pre-2019, that's still quite expensive. What would it be, like 30 times earnings? There's a lot of growth baked into that. Maybe it can achieve it, but I just think the risk reward would probably be better elsewhere. What are your thoughts on these results and the valuation, John?
I mean, I think similar to how you've outlined, they certainly on the surface, they sound great, but the comparators are, it'd be fairer to compare them to, I suppose, pre-pandemic and judge them by that. But it's, to be honest, it's not the sort of business that I would, or the sort of industry that I think I'd be interested in. Although the business model, as you sort of suggested with Terry Smith, is a more attractive one than other similar businesses in the sector. But yeah, I just don't think it's one for me, to be honest, Sam.
If the price got cut in half, would that make any difference?
I would look at it more closely, I think.
So that's probably the same, but yeah, 38 times earnings, just not a chance.
Yeah, exactly.
Should we move on to a business that isn't at 38 times earnings?
So Entain, the FTSE 100 gaming company or gambling company and owner of Ladbrokes and Coral, one that we have covered on the show before, they had their half-year results out this month with revenue up 19% to £2.1 billion and an 18% rise in net gaming revenue, with a strong recovery in the retail division after the lockdowns of 2021, which were more than offset by the decline in online. EBITDA was up 17% to £471 million, despite operating costs rising 31% with the reopening of the retail and acquisitions. In a little bit more detail then, the online division saw net gaming revenue fall 7% to £1.5 billion, up against strong comparators when most of the European estate was closed. However, on a 3-year basis, this represents annualized growth of 13%. EBITDA fell 22% to £384.7 million, with lower revenue and an 8% increase in operating costs. In the retail division, trade was buoyed by the end of lockdowns, and net gaming revenue was up more than threefold on last year at £636 million, largely driven by the UK and Italy, with volumes exceeding pre-pandemic levels in the second quarter. EBITDA came in at £141.1 million, compared with a loss of £62.7 million in the same period last year. BetMGM, the venture in the US with MGM, reported net gaming revenue of $608 million and is on track to deliver $1.3 billion for the full year and expects to deliver a cash profit during the financial year 2023. There's a free cash outflow of £101.4 million, improving from the £255.6 million last year with lower acquisition activity. If we exclude the BetMGM investment and acquisitions, free cash flow was £191.2 million. Net debt for the group stood at £2.2 billion, which equates to roughly 2.3 times cash profits. In terms of valuation, Entain has a market cap of £7.63 billion and trades at around 15.5 times forward earnings, compared with a 10-year average of 12.5 and a prospective yield of just under 2%. To me, these seem like very good results, albeit flattered in parts by the easy comparators in the retail division. But I think the big story and investment case, as we've discussed before with Entain, is the joint venture with MGM, with the group estimating the North American sports betting and iGaming market to be worth in the region of $37 billion. So logically, if BetMGM continues to dominate, this would feed through to the eventual underlying earnings. And that isn't the case with the other bookies that are listed in the UK, essentially. And it's also worth highlighting, again, if you're comparing it with other gaming companies in the UK, that over 50% of the revenue comes from outside the UK. So it's more geographically diversified. I think if I were to choose from the gaming companies, it would probably be my pick of them. and it's got those more exciting growth prospects in the States, I think it would be more just ethical reasons why I wouldn't choose Entain. But if it weren't for that, it looks like an exciting, or it has exciting prospects ahead of it for sure. And if they can pull off the US, then it doesn't look expensive. What are your thoughts, Sam?
Pretty similar. So that forward average P of 15.6 is a bit above the 10-year, but 10 years ago it didn't have the American bit. I mean, with those results, I think that PE ratio, it's not outrageous on its own. So when you think of what you're getting with the BetMGM, I would not invest in a gambling company for ethical reasons as well, although I would invest in tobacco or alcohol. But for me, I wouldn't want gambling. If you don't have those issues, I'd be taking a serious look at it. I think it looks very attractive, actually, potentially with that BetMGM, because that could be very big. I mean, already, like, I know they don't own all of it because it's a joint venture, but revenue of 1.3 billion at the full year, what's that? That's, call it £1 billion. That's 50% of their revenue already. And this thing is not old. It is growing very fast. And I think the debt's pretty manageable as well at 2.3 times cash profits. I wouldn't see any issues with that. So pretty similar to you. If it weren't for the fact I wouldn't want to own a gambling company, I would take a serious look at it.
Yeah, no, absolutely. Couldn't agree with you more. So on to our US company of the week. I mean, this is the favorite of the show, Disney.
Yeah, I would agree. I think it definitely is the favorite. There's no point denying it. So Disney have come out with their Q3 results, and in the 3 months ending 2nd of July, revenue grew 26% to $21.5 billion, and all these figures are in dollars, by the way. Disney ended the quarter with 221 million subscribers to its streaming services. So that's all the streaming services. So it's got ESPN Plus, Disney Plus, and Hulu. And it increased Disney Plus subscribers by 14.4 million. I'll just get the figure for total Disney Plus subscribers. Yeah, so Disney Plus on its own is now at 152.1 million. And that launched just over 3 years ago. Oh no, it's just over 2.5. It was before we went into lockdown. It came out that March. So that would have been March 2020, wouldn't it? So yeah, 2.5 years, 150 million subscribers. Absolutely incredible. Anyway, operating profit was up 50%, 3.6 billion, as Disney parks, experiences, and products more than offset a fall in media and entertainment. Underlying earnings per share rose from 80 cents to $1.09. Disney is not currently buying back any shares or paying any dividends. I should add as well that those subscriber figures compared to Netflix having a drop, which I think we covered like a month or so ago, which makes them even more impressive. If we split it by division, Disney Media and Entertainment saw revenue grow 11% to $14.1 billion, with the highest growth from direct consumer and content sales and licensing and other. Segment operating profit fell 32% to $1.4 billion, as strong growth in linear networks was more than offset by losses in the direct consumer division. Despite subscriber growth, the increase in the operating loss was due to a higher loss at Disney Plus and ESPN Plus and lower operating profit at Hulu. Disney Parks, Experiences and Products saw a big jump in revenue to $7.4 billion, up 70%. This was driven mostly by domestic parks and experiences, which more than doubled in revenue due to a full reopening compared to 2021's third quarter. International parks also grew, but was partially offset by the Disney Shanghai Resort as it opened for 3 days in the quarter. Segment operating profit increased from $400 million to $2.2 billion. Free cash flow fell from $528 million to $187 million as the group invested heavily in parks. Disney ended the period with net debt of $38.6 billion. In terms of valuation, business trades at a forward PE ratio of 21.9. That compares to a 10-year average of 22.9. And the prospective dividend yield for the next 12 months is 1.2%. I think it's slightly below the 10-year average, which is, I think, possibly the first time since we've covered it on the show. Maybe, actually, no, it wouldn't include lockdown because it was loss-making then. So, yeah, the first time it's been below the 10-year average PE on the show. However, there was no Disney Plus 10 years ago. I know it's loss-making now, but they are just starting to play with the prices. They have been growing it like gangbusters. And I think they've announced that in quite a few of the geographies now, prices are going to go up 30%. And if my prices go up 30% in March when I have to renew it, I'll pay it.
I think mine have already gone up that much. Mine renewed recently.
So mine, I don't renew till March. Did you pay it?
It was it was on direct debit, so yeah, it was paid.
Would you cancel it?
No.
There you go. I think they've still got a lot of pricing power because when they started, they just wanted to get people using it, and it started incredibly cheap. And on top of that, it's still growing loads as well. So I'm just not worried about those losses. And if they wanted, they could just have it as a loss leader, just drive the films and the parks and everything else. But I don't think they will. I think it's going to be very, very profitable once they get it to scale and they get the pricing right, which is going to take a few years. But I know I'm ranting a bit now, but I'd actually say it's quite cheap now. What are your thoughts on these results and the valuation, John?
I mean, they were surprisingly good results, I think, particularly on the back of Netflix. And like you say, Netflix losing subscribers and Disney is gaining them and now has more, or still gaining, and now has more subscribers than Netflix. The rest of the business is coming sort of almost fully back online since the pandemic, and it's feeding through to the earnings. It's a company that I liked before, and it's, I suppose, what we hoped for is happening with the business. So delighted that it's going in the right direction. Happy to hold the shares, and I topped up in the last couple of months anyway. And yeah, very, very happy. Continue to hold the shares. If I wasn't a shareholder, I would probably be taking a position now. I think it's very, very reasonable valuation.
I think there's a good chance I top this up in the next few weeks. I was saying it to you off air. But I think
you said I should sell my Shell shares.
I did.
Going on Disney.
Oh, well, I'd stand by that. I would stand by it. I only said it an hour ago. But yeah, I think as well, it just shows as well, like, what tough competition they are for Netflix, because Netflix is spending, this figure's a couple of years old, but Netflix spends 20 billion a year on content, but they're losing subscribers. It's very expensive valuation. Disney, I mean, they're losing all this money on the content still, but they're still profitable. They can just the amount of money they could plow into content if they wanted is insane. Like, it's just, and as well, even if they're losing money on that side, they get the benefit of it strengthening all the other sides, because they get it in the parks and the merch and the films, whereas Netflix just doesn't have that. It's just so I just don't know why you would want to own Netflix over Disney now. I don't know why you would not want to own Disney, full stop. But yeah, I think it's very, very reasonably priced for what you're getting. Of the 6 companies we've talked about this week, NatWest, Coca-Cola HBC, BAE Systems, InterContinental Hotels Group, Entain and Disney. If you had to buy one, which one would it be? And same question without Disney included.
Okay, so I mean, probably fairly obvious. Disney would be the first choice. But if I were to look at, particularly if I were to look at just the UK listed ones, I would probably go for Coca-Cola HBC, actually. I don't think the valuation is outrageous. You've got obviously the Russian-Ukraine situation, which has been priced in, and you've seen that share price fall. But I'd be quite attracted by, Coca-Cola HBC. What about you?
Exactly the same, yeah. I think it's had the negative sentiment because it is in Ukraine and Russia. Then when you actually drill in, it based on prior to looking at this, because it's the first time we covered it since the invasion of Ukraine, I based purely off the share price reaction, I would have expected Russia and Ukraine to make up a large proportion of that business, and actually turned out it's not really been affected that badly, apart from the impairment. But that's a one-off. So yeah, same answer.
Okay. Well, thank you very much for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.